Welcome back. So the last time I was on, I was talking to you about remortgaging and what a remortgage is. And today I'm going to go into a little bit of detail about the reason that people remortgage, and hopefully you can take some value from it. And if it sheds any light in the circumstances that you're in, then feel free to reach out for some guidance. But we'll start off by going through some of the main reasons that people look to remortgage. Now, the first one really is to secure a new rate. People often remortgage to secure a new interest rate and, generally speaking, not making any changes to their deal, the term, anything like that. It's just to make sure that they're securing the right deal for them at the right time. Typically, if you don't do anything, what's going to happen is you're going to go into the lender's standard variable rate. The standard variable rate historically has been higher than what's available in the fixed rates, tracker rates out there as well. And there's also discounted variable rates that are there on the market that you can take advantage of. So typically speaking, rather than going on to the standard variable rate, people tend to secure a new deal, whether that's a fixed rate, a tracker rate, a discounted rate, even an offset mortgage. There's lots of options out there to consider. And when your deal's up for review, that's what tends to be the main reason for looking at it. Now, there isn't a one deal that's going to be the best. It's going to be purely down to your circumstances. It might be that it's worthwhile staying on the standard variable rate for a short period of time. But giving advice, and I'll help clients decide on what the right thing for their circumstances is going to be. But that's the main one, is just to purely secure a new rate. But what people can also tend to do when they remortgage is they can look to release additional funds from the property. And they can look to do this for a number of reasons. They can look to do this for things such as home improvements. If kids are going to private school, they can release funds from the mortgage to pay school fees or university fees. Something that I've been noticing recently is there's a lot more people looking to add debts onto their mortgage as well. So paying off unsecured debts and adding it onto the mortgage and having one monthly payment. Even retirement costs or property deposit. There's loads of things. If you can imagine anything that you're planning to spend money on, people can add this onto their mortgage, new cars and that kind of thing. So there's plenty of reasons that people might want to consider adding money onto their mortgage. It does carry a level of risk because what you're essentially doing is increasing the mortgage balance. Your mortgage is secured against your home. So if you don't pay the mortgage, you could end up losing your home by adding these things on. So there is a risk involved. But to understand what your options are, you need to understand what the equity is and how much equity that you've got in your house. And equity is essentially the difference between the value outstanding or the value of your property and the outstanding loan that you've got or the outstanding mortgage. So, for example, if you own a property that's worth 200,000 and you've got a mortgage of 100,000, you've got 100,000 mortgage and 100,000 equity, and you can release some of that equity in order to pay for these things. And that's essentially how it works. If you're planning home improvements, there are also options out there in the market where you could borrow more than what your property's worth, provided that once the work's completed, it's going to be worth enough to cover the loan that you're needing. So there's lots of options out there regarding that. But what I'm going to do is I'm going to touch on debt consolidation in a little bit more detail. I touched on it briefly there, but with debt consolidation, there's a huge risk involved with this, and it's really important to understand it. Because I'm seeing it quite often, I thought I'll give you a brief overview of some of the key benefits, but the risks as well of repaying debts and adding them onto your mortgage. Now, the key benefit for most people is it's going to offer a reduced monthly payment usually, because what you're doing is you're essentially taking, say it's a personal loan over 5 years at 6% interest, you're taking that loan and spreading it over a much longer period of time. So say you're taking it from 5 years to 30, naturally that's going to reduce the monthly payments because it's over a longer period of time. And you could also be looking to reduce the interest rate on that as well. But the huge risk on that is because you're spreading it over such a long period of time, you could end up paying a lot more back in the long run. So while you're getting the benefit of the reduced monthly cost, in the background of that, it could end up costing you a lot more in the long run. So you need to take those kind of things into consideration. But I get it, it's easier to manage for people as well. So rather than having 5 and 6 different payments, if there's loans, credit cards, store cards, all these kind of things in the background, having one easy to manage payment on the mortgage can make it easier to manage your finances on a monthly basis. But it doesn't change the fact that what you're doing is you're essentially moving the debt from one place to another. You're not getting rid of it, you're moving it. But what you could be doing is freeing up that debt again to be used. And that's a huge risk when it comes to debt consolidation, because what you could essentially be doing is paying off £50,000 worth of unsecured debt and adding it onto the mortgage, but having then access to that £50,000 of lending again and potentially spending that money again. Huge risk involved. Most people say that they're not going to do it. And then what I tend to find is that a few months later, or a year down the line, 3 years down the line, some people are looking to do it again. So there's a huge risk, and there's a huge process that goes on at the very start to make sure that it's going to be the right thing for everyone. Now, there's never a guarantee, but you need to make sure that if you are doing it, that you understand the risks and that you don't spend that money again. But it can also, as I mentioned, free up tons of money on a monthly basis, which is a huge benefit of it. And if you weigh it up, it could be the right thing for you to do. It's just about making sure that you're getting the right advice on whether it is or not. And the final thing that we'll touch on is the term or the type of mortgage adjustment. So touched on it earlier, from moving from fixed rates to variable rates and that kind of thing. But when your deal's up, what you can do is you can switch from a variable rate to a fixed rate if you wanted to, or vice versa, depending on the flexibility that you're after. You could look to fix it in if you had tied in for 2 years. You could look to fix it in for 5 years if you wanted to. You could also adjust the term of the mortgage. So what this means is if you're looking to spread the mortgage, or if you're looking to pay the mortgage off quicker, you can reduce the term. It will increase your monthly cost, but it will then save you money in interest, and it will help you pay that property off, the mortgage off, earlier. Now, on the flip side, if you're looking to save a wee bit of money, you can spread it over a longer period of time. But as such, the monthly cost is coming down, the term's increasing, you could end up paying more in the long run. But as I touched on in the last video, remortgaging, there are key risks with it, especially if you're planning to add money onto it. So you need to think carefully before securing debts against your home, because what could happen is if you can't make the mortgage payments, your home could be repossessed if you don't make them every month. So take that into consideration. And always remember, if you are tied into a deal, you could have early repayment charges to pay before remortgaging. But I hope you found this video useful, and I'll chat to you again about